Hello and welcome to our introduction to pivot points. In this video we're going to introduce this technical indicator, show you how to calculate your pivot points. Don't worry, we've got a neat little tool that will do this for you, and give you a couple of examples of how you can use pivot points in your everyday trading. So let's get started. Pivot points, what are they? A technical indicator calculated using a financial instrument's high, low and close values. Now these values are usually taken from the previous day's trading range, so this means you'll have to use the previous day's range for today's pivot points, or last week's range if you want to calculate weekly pivot points, or last month's range if you want to calculate monthly pivot points, and so on. So why should we use pivot points? Well, they help us determine support and resistance, they're easy to calculate, they can be used for stocks and foreign exchange, can be extremely accurate, they're a leading or predictive indicator, and they act as a guide for price action. How are pivot points different? Let's look in detail at our first 2 points here. Most indicators are lagging, which means they use old data to assign a value to current price action. Now let's give you an example of this. Think of a moving average. We're using the last 10, 20, 50 or however many periods to define the moving average's value. So by very design, we're lagging. How many times have you seen the market move a whole point or 100 pips before your moving average cross system gives you a signal? By the time you get in, the rally's over and the whole move retraces on you. I know that's happened to me a few times. Pivot points are different because they use the previous day's trading range to project where price is likely to trade. So they give you an idea of where price will meet support and resistance as time progresses throughout the entire day, sort of a guide to price action if you like. How do we calculate pivot points? Well, first of all, there's a few different methods. We've got the Camarilla, DeMark, Woody's, and the most common method, the 5-point system, which is the one we'll be talking about here. Incidentally, our pivot point calculator, which we'll come on to in a bit, has 2 extra levels of support and resistance, so it's actually a 9-point system. So our 5 points are, beginning in the middle with the pivot point, then above that we've got R1 or resistance 1, R2 or resistance 2, and on your chart below the pivot point you'll find your S1 or support 1 and S2 support 2. This is the order that you'll always see your pivot points on the chart. The resistance levels will be above the pivot point and the support pivots will be below the pivot point. Now this is where the fun really begins. This is the maths. We're only going to go over this briefly, more on that in a moment. As you can see in the middle, the pivot is calculated by adding together yesterday's high, low and close, dividing it by 3. And let's take the R1 as an example, which is calculated by timesing the pivot point by 2 and minusing yesterday's low. But don't worry, we don't have to work these things out by ourselves. We've got a calculator that will do it for us. If you're watching this video on our website, then you'll find a link to our calculator on this page. If not, just type the URL at the bottom of the window into your browser. It really is simple to use, and we even have a how-to video if you manage to get stuck. Now let's take a closer look at our pivot point. It's regarded as the main area of support and resistance. Significant breaks can be a catalyst for strong moves, and direction of the break can indicate direction of a trend for the whole day. Let's take a look at a couple of ways we can actually make trades based on our pivot point. The first is using the pivot point for entries and exits. Pivot point can be a potential entry and exit level. Pivot point breaks can be an entry marker or confirmation of trend direction. Confirmation of trend reversal, which would be an exit marker or an exit signal. Let's take a couple of examples to show you what we mean. Here we're looking at a short entry example. Price is currently at 46.32 and our pivot point is at 45.90. Now our fictitious trader A expects a short price swing to develop. If the pivot point at 45.90 is broken, trader A will enter, can place a stop order to go short at 45.89 or wait and enter a market order manually. So let's move things forward a bit. Price has fallen away nicely, and notice the brief consolidation shaded in blue right around the pivot point. So trader A was right. After a brief consolidation at the pivot point, price moves much lower. The consolidation offers several entry opportunities depending on the way which you want to trade. But why do we even get this consolidation in the first place? Well, it's because the pivot point is a natural support and resistance line, so it really is no surprise that price pauses here. Move on to another example. This time we're using our pivot point as an exit marker. Notice that our pivot point is at 47. We're actually being a little bit clever here and showing you 2 days. The pivot point is only valued for the current day, which is to the right of the vertical white dashed line. Trader B is long from the previous day. Today's pivot point is at 47, which you've already mentioned. If 47 is broken, Trader B is going to exit. The pivot point acts as an exit signal and basically an area to take profits on the trade. I'd like you to take a look here at just how rapidly price broke down after breaking the pivot point. Price did in fact break today's pivot point at 47. Trader B's protective stop is broken and he or she exits the trade and takes profit off the table. Now let's talk about how to use our R and S pivots, or our resistance 1 and resistance 2 and support 1 and support 2 as they're also known. Now it's perfectly acceptable to use R and S pivots as entry and exit strike prices, just as we did with our pivot point. However, these areas between R1 and R2 and S1 and S2 can also be used as support and resistance zones. Traders can fade an existing trend or participate in a momentum breakout of one of these zones. Here's an example of what we mean. This is a chart with the areas between the R and S pivots marked as zones. You'll clearly see between the R1 and the R2, that's a resistance zone, and the area between S1 and S2 shaded in green, that's a support zone, and you can see the pivot point in the middle. So as we've already mentioned, the area between R1 and R2 is a resistance zone, which is marked in red, and the area between S1 and S2 is a support zone, which is marked in green. A closer look at our resistance zone. Notice how price isn't strong enough to break the resistance zone, and once it's failed, it falls away rapidly. Failure at the resistance zone called a rapid sell-off, which broke our pivot point easily, and price enters the support zone and consolidates briefly. The downtrend is so strong there is a momentum breakout of the support zone, which you can see as price moves through the S2, and price actually remains below support for the rest of the day, using the S2 line as a bit of a resistance there on a pullback. So let's wrap things up. The one thing I really want you to take out of this is be open-minded. Pivot points are open to interpretation. There are no hard and fast rules. Every trader can be unique. Combine technical analysis tools. Find what works for you. And watch for the relationship between price and pivot points. Notice how price interacts with pivots, but pivots don't tell price what to do. And we've got some example trading strategies to follow in later videos. That's it. Thanks for watching. Come and visit us at passiontrading.com/pivot points for all of our videos. Or if you're already here, use the navigation links below. You'll be able to move on to our next video, where we'll be looking at our first trading system, the pivot point breakout.